All right. Good morning, everybody. Good morning to all you wonderful melon heads out there. I hope you guys are well. Today is Tuesday, 8/8/23. And good God, it's going to be a day, folks. As my moderator, Mish, put it in a story from his Navy days, it's a mess out there. It is a mess indeed today. So what is going on? Well, there's a lot happening today. Moody's, not to be outdone by Fitch's downgrades. Last week, you may recall last week, Fitch downgraded the U.S. credit rating. They would go on to downgrade Fannie Mae and Freddie Mac, the biggest issuers of mortgage-backed securities. So Fitch basically downgraded the entire global debt market yesterday, or at least the entire U.S. debt market. Well, Moody says, hold my beer. They just downgraded, well, pretty much everybody in the banking sector, that is. Not really the big banks, but Moody's came out last night with a note that downgraded simultaneously the credit rating for 10 different banks in one fell swoop. This was like your Godfather-esque end of the movie murder montage, just wiping out banks. You also had they downgraded the credit outlooks for 11 other banks. So in total, 21 specific banks were mentioned in this Moody's letter, and every single one of them, their shares are down today. It's dragging down the entirety of the banking sector. So we've got potentially a rekindling of the U.S. banking crisis. Now, I don't want to go too far with this, right? There are no banks failing right now. That's not happening. But a lot of banks were just downgraded. By the way, I apologize for the fuzzy picture, guys. My internet is slow today. We had a wicked storm, like I'm sure a lot of you folks in the States went through yesterday. So things are still a little iffy on the internet connection. So apologies for the grainy jack. But the Moody's note cited profitability risk and the ability to raise capital. A lot of these smaller banks are having their margins squeezed because they've had to raise the interest rates that they pay on their savings account to stop the deposit flight out of the bank. That was something that started in March. Of course, they're having to pay more for the deposits, but they're also making fewer loans, so they're making less interest in income. That means their profitability is being hurt. That hurts their ability to raise capital. The Moody's note also mentioned a mild recession. Gag me with that mild recession talk or that soft landing. Who in their right mind is still out there, besides Jim Cramer, who is still out there saying no recession? Who is still saying soft landing? Wait till you see this data from China that came out. I got your soft landing right here. I got your mild recession right here. And of course, the note from Moody's also mentioned commercial real estate. That's a big one, guys. That video I did a few days ago about the malls, go back and check that out if you haven't seen that video. It says Mallmageddon in the thumbnail. The numbers attached to some of these malls, the size of the debt, the value that these buildings are worth today, what they were appraised at back in 2015, 2016. The numbers will blow your mind, and then factor that is going on in every county and every parish across the country. Mild recession indeed. And also Country Garden. Remember the Chinese developer crisis? Remember the Evergrande story? Something I covered a lot in the early days of this channel back in 2021. And I've been saying, even though I haven't been covering it as closely, I said, guys, that story did not go away. It's still out there. They still owe all that money. They're just not paying people, but they're not actually going bankrupt. They're just kind of there. But that debt is still going up in smoke. Well, you can add Country Garden to the list. Country Garden, the behemoth, formerly the largest developer in the fastest growing economy in the world. They missed coupon payments on 2 of their dollar-denominated bonds. Some of their bonds are now trading at 9 cents on the dollar. Whoops. That's a big one. Bad things are happening in China today, guys. Very bad things are going on in China, and very bad things are going on in the U.S. debt market. But for now, there are very good things going on with that like button and that subscribe button. So as I shrink my big melon of a head, won't you please like this video? And if you're new to the channel, welcome, and won't you please subscribe? We do this every day. Let's go through markets and see what's going on. We have got the Fear Greed Index. We're going to refresh this because I think this bank downgrade may have put a little bit of the fear back into the markets. We're at 67, still deep into greed territory, but down off the lows that we've been in. The market, even despite everything, still being driven by greed. Amazing. S&P 500 is down 31 points or 0.69% this morning, 4,487 on the S&P. The Dow is down 240. That's after up 400 points yesterday. Dow had a ripping day yesterday, giving back more than half of that. We'll see what we close at today. Currently 35,233 on the Dow, down 0.67%. Also, and the NASDAQ leading the way lower, down 0.8% or 111 points, 13,885 for the tech-heavy NASDAQ. And look at the DXY this morning, up another 57 basis points, currently at 102.63. We were as high as 102.75 this morning. Guys, what we have going on right now is a sell-off in most assets. We've got a flight to dollars and, to a lesser extent, a flight to bonds. We've got a flight to safety, although gold and silver are kind of being left out of that this morning. Let's look at bonds, though, shall we? Check out the U.S. 30-year. We've got yields down 8.8 basis points on the 30-year. That's at 4.17, down 2%. The 10-year yielding pretty much flat 4. That's down 7 basis points. The 2-year, 4.76. That's actually up a little bit on the day. And the 1 month at 5.38. So we've got the long end of the curve is lower. Guys, remember, yields and price are inversely correlated. Yields going lower, that's bond prices going higher. So we've got people are running to dollars today. People are running to bonds today for safety. Usually gold and silver would do okay in that environment, but that's not what's happening. We have got gold is down $10 this morning at 0.54%, 1,959 an ounce on gold. Silver is down 41 cents. Another tough day for silver, down 1.79% at 22.81. And speaking of silver, I will be speaking at the Stock Pulse Silver Symposium at Caesars Palace in beautiful Las Vegas on September 29th and October 1st, just 52 days away. If you guys are in the area or if you are looking to take a trip, what better excuse to visit Las Vegas than to come to the Stock Pulse Silver Symposium and meet some of your favorite financial YouTubers? There is a link down below in the description. If you use that link, it's an affiliate link, by the way, you will get 10% off on your tickets to the Silver Symposium. 52 days and counting until that. Back on the commodities board, we've got WTI crude is down $1.47 or 1.8% this morning. That's at $80.47. Now, still off its recent lows, but we got a big sell-off happening in oil today. Guys, this is the case where yesterday and really the whole last week, we've been talking all about demand, the demand problem or the supply problem. Everybody was worried about the Saudis cutting, the Russians cutting, right? The rig count falling. There's been a worry about tightness of supply. That's been dominating the narrative of oil. That flipped on its head today. Now everybody's worried about demand. And when you see these numbers in China, you're going to understand why people are worried about demand. Same thing with this bank downgrade. It's got people saying, hey, maybe the oil demand won't be there. And this is why I haven't really made a bullish or bearish call on oil yet, because there's two very powerful forces pulling in opposite directions here. Yes, supplies are getting tighter. The Saudis are cutting the refilling of the SPR. That's got to happen. But at the same time, I do not subscribe to this mild recession nonsense. I think this is going to be one of the worst recessions the country's ever seen, if not the worst. And so oil demand is also going to take a hit. And when supply and demand are both falling, price doesn't necessarily move. Case in point, the real estate market. Look at what's going on in housing right now. Prices aren't really moving, even though supply is falling, but demand is also falling. So until one of those forces prevails, price doesn't move. And I can't tell you which force is going to prevail in the oil market because these forces are gigantic right now. Moving on, here is the main story today, guys. This is the big one. Moody's cuts U.S. banks on mounting funding costs and office risk. They're finally starting to talk about commercial real estate. We've been warning on this channel for the better part of a year about this. The Economic Ninja has been warning about this for the better part of a year, way out in front of this. A year ago, 2 years ago, nobody even knew what a CMBS was. This is going to be commonplace very soon. Rating company downgrades 10 lenders, citing a dimmer outlook. U.S. Bancorp, BNY Mellon among 6 firms facing potential cuts. Moody's Investor Service lowered credit ratings for 10 small and mid-sized U.S. banks and said it may downgrade major lenders, including U.S. Bancorp, Bank of New York Mellon, State Street, and Truist Financial, as part of a sweeping look at mounting pressures in the industry. Now, let's take a look at some of these names here. The firms that had their ratings actually cut. That was M&T. M&T Bank, that's ticker MTB. We've got Webster Financial Corp, BOK Financial Corp, Old National Bank Corp, Pinnacle Financial Partners, Fulton Financial Corp, and Northern Trust Co. And they're also saying Cullen and Frost bankers are also under review for downgrades. Now, that was the actual downgrades, but you also had a negative outlook, which is, I guess, one step above a downgrade, a negative outlook for 11 different banks. And some of those were PNC Financial Services, Capital One Financial, Citizens Financial Group, Fifth Third Bank Corp, Regions Financial Corp, Ally Financial, Bank OZK, and Huntington Bank Shares. They're cutting everybody. No one was spared. Now, let's talk a little bit here in this Reuters article, again, about the same topic. Moody's downgrades U.S. banks, warns of possible cuts to others. They did a pretty good job of talking about the reasoning behind these cuts. And let me know if any of this sounds familiar, if this is talking about anything that maybe you might have heard on this channel weeks or even months ago. Many banks' second quarter results showed growing profitability pressures that will reduce their ability to generate internal capital. In other words, these banks' profit margins are being squeezed because they're having to pay higher interest rates to keep deposits, and that's eating into their profit margins. And if they have no profit margins, then they can't raise capital. It also makes it harder to sell shares to raise capital because the shares go down in value when the profits go down. So these banks are fighting for their lives. This comes as a mild U.S. recession. There's that mild recession again. Good God. This comes as a mild recession is on the horizon for early 2024, and asset quality looks set to decline with particular risks in some banks' commercial real estate portfolios. There's that office risk. There's those malls that we talked about. And also, guys, multifamily real estate, multifamily residential is not all clear of this either. Commercial real estate is in big trouble. Moody said elevated commercial real estate exposures are a key risk due to high interest rates, declines in office demand as a result of remote work, and a reduction in the availability of CRE credit. Put a pin in that availability of CRE credit. We'll touch on that in just a moment. Let's take a look at what some of these banks are doing this morning. This is the S&P Bank ETF, ticker KBE, down 3.92%. That's the whole banking sector, guys. It's down almost 4%. This is big. Okay, this is like that day I did that spontaneous live stream and I said, guys, something is up in the banks. I don't know what it is, but they're all down. They were all down about 3 or 4%. Of course, that would eventually result in the Silicon Valley and Signature Bank collapse. Again, this is everywhere, guys, the entire sector. Let's look at some of the individual members here. I'm going to have to refresh these because I'm not sure how bad they are. M&T Bank down 4.75%, almost 5% for M&T. Capital One down 3.25%. Webster Financial down almost 4%. Bank of New York Mellon down 2.5%. U.S. Bancorp down 4.8%, almost 5%. State Street down 3.3%. Truist down 4.5%. You guys get the picture here? These banks are getting clobbered right now. Now, keep in mind, again, this is not a bank run that's going on right now. This was a downgrade. But I don't want to get accused of fudding too much here, but when you see the stock in your bank dropping rapidly in a single day, that makes some people fearful, and it makes them want to go get their money, and that can result in a bank run. So this is one of those psychological triggers that Moody's may have just reignited the crisis. Emphasis may. That has not necessarily happened yet. These banks are not failing at the moment. The FDIC hasn't seized anybody. It's just their stocks are down because Moody's, the credit rating agencies, who have largely been asleep at the wheel as this crisis has developed, are finally catching up and finally starting to talk about this. Let me get to a couple people real quick here. We've got, thank you, Mr. Mike Bender from Robin RC. He says, good morning, Jack. Nothing to see. Keep on walking. Chinese real estate is now 50% down in some areas from their all-time high. Greatest investment ever. Mike, thank you very much, sir, for the super chat. And that is an awesome segue. Let's talk about that, Mike. And thank you, sir, again for the super chat. Let's talk about Chinese real estate because check this out. China trade plunges more than forecast in blow to recovery. Exports dropped 14.5% year over year in July, the worst decline since February of 2020. You might recall February of 2020 kind of sucked, everybody. There was a thing, remember? Remember that? This was the worst decline since that started. 14.5%. This is not a modest decline in exports. And guys, China exports to freaking everybody. Everyone gets their stuff from China. And it's not just exports. Imports fell 12.4%, much deeper than economists expected. China's trade plunged in July as slowing global demand clouded the outlook for exports, while domestic pressures weighed on imports in a hit to the economic recovery. Why do they always call it that? The economic recovery. What economic recovery? There is no economic recovery in China. They reopened and everybody was like, yay, growth. And then there wasn't any. There is no economic recovery. The insatiable beast, that hungry growth engine in China that consumed 50% of the world's concrete and steel and copper and coal and everything for the last 30 years, it's dead. The China property bubble has burst and reality is starting to set in. Now, I want to temper this a little bit with one point I want to make here. Some economists also attributed the decline in imports to falling commodity prices, meaning that even though Chinese factories were still buying materials, they were doing so at lower prices. For example, the value of crude oil imports fell more than 12% in the first 7 months of 2023. That's from a year ago. But by volume, crude oil actually jumped by around 12% in that time. So China's buying more oil, but the price of the oil is down, so it doesn't really change all that much. Now, for sure, the lower commodity prices versus a year ago is playing a role here, but you're talking about economy-wide, a collapse of over 12.5%. Just the decline in oil does not explain that because this is a decline across the board. Oil is partially offsetting that, but that's also, or partially explaining that, but nowhere near all of it. And let's talk about that resilient American consumer and that strong American consumer and that mild recession again, or the soft landing. Check this paragraph out. Shipments to the U.S. plummeted 23.1% in July, according to the customs data. Exports to other markets, including Japan, South Korea, Taiwan, ASEAN, EU, Brazil, and Australia, all dropped by double-digit percentages too. Everybody is slowing down, guys. Global recession. And this is why I grind my teeth when I hear the soft landing. And when Jim Cramer says, bye, 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 there's no recession. The Fed stuck the soft landing. I love Jerome Powell. I have a picture of him on my wall. No. There is no mild recession. There is no soft landing. U.S. shipments from China to the U.S., the world's factory, shipments to the world's factory, to the world's largest consumer economy, are down by almost a quarter in 1 year. That's not even a recession, let alone a mild recession. Guys, those are depression level numbers. This is big. What resilient American consumer? What strong American consumer? I keep hearing about this second half growth is going to be reignited. If the second half growth was going to be reignited, then they already would have ordered that stuff from China. It already would have shipped here. It would be on a boat or at the dock being offloaded right now so it could reach the store before we buy it in the second half. It didn't happen. This is very bad. And you can see it in Country Garden. Misses bond payments as China property fears flare. Country Garden, these guys were even bigger than Evergrande a few years ago. This was the biggest property developer in the biggest property development economy in the world, and they're missing their bond payments. Country Garden said on Tuesday it had not paid $2. Country Garden said on Tuesday it has not paid $2 bond coupons due on August 6th, totaling $22.5 million, confirming market fears that the biggest privately owned developer in China is slipping into repayment troubles. The bonds in question are notes due in February of 26 and August of 2030. Both payments have 30-day grace periods, according to investors citing prospectuses. Right, so they're into their 30-day grace period, which means they have not defaulted on these bonds. Want to emphasize that. But they missed the payments, the coupon payment. That's the interest that's due to the bondholders. They didn't pay them, and it was due a few days ago. So they're into their 30-day grace period. That means that this company has liquidity problems. This company has cash problems. And why is that so worrying? Well, this company has pre-sold 650,000 homes in China. They owe 650,000 places to live that they've already sold, and they don't have $22 million to pay the coupon on their bond payment, let alone to pay back the principal. That's just the interest payment. So these guys owe billions of dollars, and they owe hundreds of thousands of homes, and they're out of money. I'm sure this is going to end very well for Country Garden and all the people who are investing in and all the people who are owed homes by them. Guys, this is not just a decline. It's not just a gully. This is a collapse. And it's September 2025 bond traded at 9.21 cents on the dollar. 9.25 cents on the dollar for Country Garden's bonds. This was one of the safest investments in the world 3 years ago. Now their debt is trading at less than 10% of face value. That is how much confidence people have in Country Garden. And again, these guys owe 650,000 apartments. And again, it's not just a China thing, guys. Wall Street Journal, new lending by mortgage REITs has dried up. Blackstone Mortgage Trust and KKR Real Estate Finance Trust halt loan origination to shore up balance sheets. Starwood cuts back. Now, remember they were talking about credit availability in that Moody's downgrade? When they said, hey, we're worried about commercial real estate and we're worried about credit availability. This is that credit availability going away. Some of the biggest names in commercial real estate lending have all but turned off the spigot. Blackstone Mortgage Trust and KKR Real Estate Finance Trust, two of the biggest MREITs, or mortgage real estate investment trusts, have halted loans to any new borrowers. While these firms continue providing financing related to existing loans, they didn't originate any new loans during the first half of this year, according to the companies. So, guys, they're not just cutting back their exposure. No new loans, zero in the entire first half of the year. And these are the biggest investors in not mortgage-backed securities, in MREITs, mortgage REITs. Also, Starwood Property Trust, the other biggest investor in MREITs, another lender in the sector, they have greatly decreased their appetite for new lending in recent quarters, securities filings show. So Blackstone and KKR, they're out entirely. Starwood has cut way back. Mortgage REITs, which lend to property owners instead of buying and developing real estate like equity-oriented REITs, typically originate an average of about $10 billion in loans per quarter, according to Jade Ramani, an analyst at three names I don't want to bother pronouncing. But lately, hardly anyone has made any new loans. Now, look, think about this, guys. If the lenders are not making new loans, that means there is less dollars available for people who need to borrow money in commercial real estate. So supply and demand. If the supply of money goes down, but demand stays the same, then the price of money goes up. And the price of money is interest rates, which means the people who own those malls that I was talking about in that video, who have to refinance their loans, they're going to have to pay even higher interest rates because now they're going to have to outbid one another for the few loans that are available, for the little bit of liquidity that is out there. They're going to have to compete with each other and outbid for those loans, which means the interest rates are going even higher. There's a reckoning coming in the commercial real estate market. There it is for all to see. And congratulations to American consumers and your $1 trillion in credit card debt. This is consumer credit, all revolving plans for all commercial banks. I've been following this one for quite a while, and we are now at $1 trillion in consumer credit. We just hit that level the other day. And last but not least, guys, I have to say we are moving. And, well, thank you. Thank you very much. I put a poll out the other day, and I said we're considering changing our time slot from 9:30 to 9 o'clock. Well, some 650 people answered that poll, and 80% of you said 9 a.m. was preferred to 9:30. So effective next Monday, we're going to stay at this time slot for the rest of this week, but effective next Monday, we are going to be going live at 9 a.m. instead of 9:30. That way you guys don't have to split your attention between me and the opening bell. And don't worry for you 9:30 folks, you'll still be able to catch the show on recording, just it will not be live at 9:30. And I have a couple of people I have to say thank you to. Mr. Steve Woitis says, thank you, sir, very much for your super chat. He says 20% drop in condo and detached home market in August. That's a big drop. That's a bear market, 20%. I think investors are getting nervous and dumping unsold Toronto properties. I think investors are getting nervous everywhere. Guys, I did a video not too long ago about Starwood, Barry Sternlicht's company. They were selling 2,000 of these single-family homes that they bought. The investors, the institutional buyers who bought up all that single-family residential real estate in 2021 and 2022, they're flipping those trades now. They're getting out. They're selling it. And the investors, absolutely. It's potentially a source of new supply is people who bought investment properties, realize they don't cash flow, and dumping them into an illiquid market. We could see a very rapid correction. Absolutely, Steve Woitis. Thank you, sir, for the super chat, the support of the channel. And thank you, Nashville Pasta Man, who says cap rates for multifamily residential are getting squeezed. The loans don't make any sense. They are the PE ratio. By the way, cap rate, that is the income or the cash flow from the property divided by the value of the property. And you're right, those cap rates are headed south fast because the valuations of the properties are at all-time highs, but the incomes are starting to fall. It's bad for real estate investors. Right on, Nashville Pasta Man. Without the ability to bubble because the refi windows are narrow. Thoughts? You know, we've seen this, Nashville, right? How many people are out there buying houses right now on spec saying they're going to go up in value because I think they're going to lower rates and I'm going to refinance in a few years? Well, what if they don't lower rates? Or what if they wait too long to lower rates? And what if the value of your property is down so much that you are way underwater and you can't refinance? And the incomes on those properties are too low. As Nashville's pointing out, those cap rates are way down. So those properties, those rentals are not going to be cash flowing enough to service these expensive mortgages. It's not going to end well for these people. You're right on the money, Nashville Pasta Man. Thank you, sir, very much for the super chat, the support of the channel. Thank you, Mike Kathman. Thank you, Mike. It says mild recession with credit card debt breaking $1 trillion. Yes, a mild recession. There's a mild recession is coming, yes. $1 trillion equals a bloodbath. This will be a cascade of multiple effects, breaking folks hanging on by their fingertips. You know, keep in mind that $1 trillion balance. While that balance is so high, the carrying cost, the interest rate on that balance is also so high. Joe Brown did a great video yesterday about the U.S. debt, about how, yes, we've had interest rates this high before, but the last time interest rates were this high, the national debt was 1/7 of what it is now. So it's not comparable. These are not apples to apples comparisons. And that logic holds up here, Mike Kathman, to your comment about credit cards. Yeah, we've had high credit card balances before, never $1 trillion. But $1 trillion and high interest rates? No way. Now, I would temper this by saying delinquencies in credit cards are still pretty low. They're still below pre-pandemic levels. So people haven't started defaulting on these credit cards yet, but you better believe that's coming. It's a mathematical certainty it is coming. Thank you very much, Mike Kathman. Thank you guys for all these super chats today. I appreciate the generosity very much and the support of the channel. And here's Mike Robin is back again. He says freight's down 25%. Socialists' new prosperity. Yeah, new prosperity. My biggest problem with socialism and communism as a whole is it treats wealth like a zero-sum game. And this is why communists and socialists, their cousins, suck at running economies, because nobody builds anything, nobody makes anything or grows anything. Everybody just fights over what somebody else already built, made, or grew. Because there's no freaking incentive to build or grow or make in communism or socialism, because everybody else is just going to take it. And that's why the economies never grow under these lousy economic models. That's why capitalism rules every time. Is capitalism a perfect system? No, it is not. Human beings are imperfect. Treating people like an ant colony where everybody will do exactly what needs to be done for the collective is an incorrect approach, because human beings are not ants. We are flawed individuals, and the best way to maximize our productivity and our prosperity is to treat us like individuals, and that's why capitalism wins every time. Every time. It's not even close, guys. Is it great? Is it perfect? No. But nobody ever stacked up bodies like the communists did. Not even close. I mean, smallpox is left holding the communist beers after the body count communism had in the last century. Thank you, Mike Bender from Robin RC Models. And thanks, Dan Hedin. What's going on, brother? He says, how much damage done to these properties with the flood that just rolled through China? Are these properties insured? You know, there's always flooding in certain regions. I know there was a lot of floods in China recently. I don't know that the flooding is necessarily going to be a risk to the property sector, but I would caution flooding, natural disasters, that can be a very big hit to the insurance sector. And the insurance sector is basically the banking sector. They behave the same way. They invest in assets. And if they have to pay out too much in insurance, they have to liquidate assets, which can cause a downward spiral in the value of those assets, which could cause other people to liquidate. So I think the real risk here from these floods is going to be in the insurance sector. I think that's where you want to pay attention. If there's anything that comes out of that, we'll see it in insurance first. I don't necessarily think that's going to hit like the Country Garden or any of the developers necessarily, but I do think it'll hit the banks, which could affect the availability of credit, which could have knock-on effects for the developers. You're just a few stages removed there before you get to the developers. But thank you very much, Dan Hadeen, for the super chat. Whew, you guys are pushing me this morning. We ran a half hour. I apologize for that very much. But I want to say thank you so much, everybody, for your time, for your super chats, for spending your mornings here with us. Again, don't forget that new time slot at 9 o'clock starting next Monday. Also, don't forget to check out the Silver Symposium. Get your tickets. Use that link below. And looking forward to talking to you Patreon people tomorrow at 2 p.m. Eastern Time for our weekly Zoom call. Another link down below to that one. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.